Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So, what will be our today's topic, Nick?
So, I was thinking we could briefly discuss the differences between venture capital investing, which is very well known. People see it on Shark Tank, and they see it. They always hear about the people buying in on the ground floor before the thing goes big, when the inventor or the startup is just at the very beginning of their journey. So it gets a lot of publicity, and then you get private equity, which is buying businesses in their entirety, and they're not on the stock market. And you go there and you find this place, and you see if you like the business, you buy the whole thing. So there's a lot of private equity firms out there doing that. And then, of course, you've got hedge funds, which is buying on the public market companies that are public. And so we'll discuss a little bit about each one and what the differences are.
Yeah, this is a really good topic, and our viewers probably heard about these websites where you can just back up the startup, like Kickstarter, or sites like Y Combinator, where they invest in early stage startups, putting their money into next big ideas which disrupt the market and the whole industry. If you go and see the returns, you will be fascinated, because they can actually make thousands X on their money returns. But why this thing is so risky, and why it is worse than investing in private equity public markets? What do you think, Nick?
It's good for a certain kind of investor, and if you're really, really good at certain skills, if you've got those under your belt, then you could probably do, as an individual, you might do better with that than the other two. But I would say for the average person, you don't have those skills. It's a rare skill set to have, because you're not betting on the company, you're not betting on the product. When you're buying venture capital, you're effectively betting on the entrepreneur that you're backing. You're betting not on the horse, you're betting on the rider. And it's really, you need skills to be able to read. Are these people finishers? Do they finish projects they start? Are they people who have all the skills necessary to bring this thing from nothing to something big? And it's a really hard proposition. As investors, as value investors, we like to look at all the different things that are transparent and factual, to be able to determine the likelihood of success. Venture capital is a very, everything's an art in investing, really, but it makes value investing look like a science. It's a very soft science, figuring out if a person is worth betting on. You also need a lot of capital, because you're going to have to make about 100 bets a year, and only a couple of them might pay off and give you that 100x or 1000x. It can be very lucrative, but it depends on your ability to pick winners. As an individual, you only have enough money to maybe bet on a couple per year, and if you're wrong, you lose all that money. So it's very high downside with very little upside if you're small and you don't have the skills. So I would stay away from venture capital unless it's specifically something you've already sort of proven yourself adept in. What are your thoughts on that?
Yeah, I definitely agree. We also need to consider, if you want to be a value investor in such kind of companies, there is no value investing here. There is no track record. You are, as you said, betting on the jockey, not the horse, because you do not know whether the idea will go on the market or not. Will it be the market fit or not? Will it be the needed amount of money in the beginning, or you need to put another $1 or $10 million into the business? There are no revenues. Usually some people can invest in the ideas and prototypes, like MVP, minimal viable product. So it is really, really hard in order to understand the probabilities and consequences of this particular business. Actually, in venture capital, you can cash out, and you need to be prepared to freeze your money for a certain period of time. For example, 2 years or 3 years without touching them, and understanding that this money can go to zero. That's why you need a lot of bets in order to cover your losses. In venture capital, there are only two ways, I think, when you can earn the money. First is when you invest in the company and this company goes public, so IPO. You have the options for the company and you sell them as a stocks, collecting the profit. And the second one is then you invest in the company. This company will be bought by different venture fund on the next stage, or it will be acquired by the larger company or business. In both cases, the probability that your startup and the startup of the particular person will go from zero to acquisition from other company or IPO is so little that you need more than 100 bets in order to be successful.
There's another option. Obviously, you can stay in the company. It never gets sold. It never goes public. You make a small amount of whatever your cut of the cash flow is. So you just make that cash flow generation. But I think the important thing you said there was that it's not value investing, and therefore, according to my definition, it's not investing at all. I really class these things separately. I believe that it would be speculation because there is no underlying value that can be determined. So you are speculating that somebody will buy it at a higher price or that the business will even succeed. It is not quite as bad as gambling because you can know the business very well. You can know the product, you can know the market, you can know the people. So it's not gambling, but it is closer, I think, on the spectrum to gambling than it would be to investing. So that's all I have to say really about venture capital. It's a fascinating space. I'm not saying I'd never play there, but it is not what I consider to be true investing, which is what we're discussing here. It is an interesting thing, and VCs, venture capitalists, are super needed. For if it wasn't for them, the companies would never arrive at the state where we can invest in them. Thank you, venture capitalists.
Yeah, because actually these guys move the industry and move the world forward, because all these new ideas and all these new businesses which can disrupt the industry can actually be risen from the venture capital. But anyway, we as value investors need to look at those opportunities which already have traction and where we can understand what we are buying. And I think that value investing starts, the company is on that stage that it already has the revenue and some kind of profit, and it needs some money in order to grow. It can be the small or medium business, and these kind of deals are called private equity. So when you go and you personally meet the owner of the business, the CEO of LLC, and you just communicate freely with him or her, and you just understand that, okay, I can purchase 10, 20, 30%, 50% of the current company for certain amount of dollars, I will receive the particular dividends and particular income after a certain period of time. Then we can either sell the company, or this can be just like the cash cow or the future cash flow for your investments and for your life.
I think private equity definitely, when done right, is considered real investing because you can figure out the underlying value of the business. And some of the best investments I've ever heard of were private equity. Essentially, what it is you're buying the entire business before it goes public while it's still private. And now you are in the business instead of somebody else. And if you're a private equity fund, then you're buying lots of those businesses. And then you either do a value add where you improve the numbers, and then at a later date you can sell it to another private equity company or to an individual, or you can go public, and that really increases the revenue. But effectively, a good investment, private equity can be a good investment. The only downside with private equity is that, unlike public companies, you really are having a larger risk when it comes to two things. One, that the numbers and facts and information that's being provided to you is accurate. That's little bit risky in that business. It's much harder to verify. It's much harder to trust. While in public equity, if their reporting is not accurate, they all go to jail. And so there's a commitment by public companies to really show accurate numbers. At least here in the United States, some countries are a little more lax on that. So that's why I don't invest in certain countries like China. I hope they fix that problem. I would love to invest in China, but I like the numbers to be accurate, and so that's number one reason I prefer public equity here in the US, the stock market, because the numbers can be accurate, and you don't know for sure if they're accurate with private equity. You could try and verify them, but for me, I like that certainty. I know I pay more for public companies because of that certainty, but for me, it's worth it. With private equity, if you buy a whole company, if you want to get out of that investment, you need the money for something else, you got to sell that whole company, and that's really going to be a time thing. With public equity, you've got a lot of liquidity. You can take your money out any time, and that's another reason that public companies are more expensive, is because you've got those two main benefits: liquidity and transparency. I much prefer public because of that, but private is probably half the price per company for that reason. And so that's something to consider. Your thoughts?
Yeah, I definitely agree with that. When you do private equity deals, at least you have numbers. If we compare it to venture capital, there are no numbers or small numbers at all. And actually, from the positive side, you actually buy the cash flow. And the most public and popular investors started from private equity deals, like Warren Buffett, because he didn't have enough money to support his growth as the fund and as the company. And he bought private equity deals, carefully evaluating them, changing the management, improving the structure of the business, and then just exiting from that or keeping in his museum of wonderful business. But from the downside point of view, it is really hard to negotiate with the person about the purchase price. So if we compare to the public market, it is auction driven. So the company it can worth 100 million and has asset value of 1 billion because the crowd is so depressed and undervalues the company. But in private equity deals, there is really rare that you can do such kind of deals because you can propose a low amount of money to the CEO and he just denies that and you're done. And you do not have any other opportunities to convince him or her. He already knows the value of the company. And as far as any unexpected event happens, you cannot purchase the company at the price you like. In this case, this is the negative thing. But anyway, if you would like to support it, you need stable cash flow for your everyday and monthly needs, this can be a good solution for you, and you have the money for living and for investing.
I think that this will be a slightly shorter episode than usual, but I'd like to make my closing comment and an example of a really good private equity purchase. So Warren Buffett invests both in private equity and in public. So his fund does both. Many years ago, he purchased a company called See's Candies. I believe he purchased See's Candies originally for $25 million. And as of today's date, the company creates $75 million of free cash flow, which all goes to Warren Buffett's company that he can do whatever he wants with. He doesn't put it towards growth of See's Candies, which he could. There are other things you could do with it as the owner of See's Candies, but he uses that free cash flow to buy other companies, to invest in other things. So he has a free $75 million every year forever for an original purchase price of $25 million. One of the greatest investing stories I've ever heard.
Another part and another great way is investing in public companies. Instead of private equity or venture capital, there is a completely different story where you have the pure numbers. If the numbers are wrong, as you said, the CEO can go to jail in the United States and Europe. And you have the auction-driven market. The asset can be undervalued and deeply undervalued by the market because people think that the company just does poor job even though the numbers are great. And you also have the amazing opportunities like fractional share purchases. So if you do not have enough money, you can purchase fractional shares, and you have a huge liquidity on the market. So you can sell and purchase shares at any time.
I neglected to dig into the public market, which is the best of all the worlds, in my opinion, with all those things that you've just said and much more, but definitely focusing on the mispricing of the market. That happens very regularly, and that is a huge benefit to an investor because basically the stuff is on sale, and we know we can flip that for a profit when the market realizes it's a mistake, and we can get into companies at a good margin of safety, and that's definitely the way to go. And that's what we're really talking about on this podcast. And so,
yeah, that's all for today. Thank you for watching us. And if you have any additional questions or ideas about future episodes, please write them down in the comments below. So stay tuned and subscribe to the channel. See you next time.